Welcome back. We're gonna talk about Nvidia, which had earnings today, and it did really well. And regardless of that, after market, the price of the stock seems to be going down, kind of following the current trend in the stock market where everything goes down regardless. So we want to examine Nvidia using our proper analysis here, our proper fundamental analysis, in order to understand how much the company is making in terms of money and operations, and also deduce what is an appropriate price to pay for the stock. And at the end of this video, we're gonna be doing a full-blown DCF model that I created in order to, to discover what kind of price makes sense to pay for Nvidia today. Now, if you're watching this channel for a long time now, you know that I'm not pumping up stuff. I'm just saying things exactly as I see them here. It's mathematics and it's data analysis. So don't expect me to hype up anything because I won't. It's all it's all about economics and data, which I know that a lot of you appreciate, and thank you for being around. And if you haven't subscribed to the channel and you want to be part of this and keep watching the videos, please do, because that really helps. And also like the video, because that also really helps. You can also join our Discord channel, a link in the description box below. Okay, let's do this. Nvidia has been a high flyer, as you can say, really skyrocketing for a long time now. And all of a sudden, going from 340 or so down to 600 and 255, it looks right now, actually, that it's going to open up about that price. So what's going on here? The outstanding shares are 2.5 billion for Nvidia. It's a very large number here, as you can see. And it did plummet at some point, and then Nvidia, obviously, because they saw that the price of the stock was skyrocketing, started diluting investors. And this is what many companies typically do. When the price of the stock skyrockets, they actually take advantage of that and sell you more stocks. So you have to be cautious about it, and you don't want to be buying into the high, because you end up getting diluted here. So let's take a closer look now let me find it here, at Nvidia's income statement, which is over here. And Nvidia is obviously a great company, and we're going to take it down to the last 5 or 6 years, as we typically do. About 5 is right. And you will see that the margins of the company, the year-over-year growth, basically has been growing here from 9 billion to 24 billion, along with the gross profit, and the most important thing, the net income, from 3 billion to 8.2 billion. So business is doing really well here, it looks like. What about the balance sheet? The balance sheet of the company growing from 11 billion to 40 billion. Remember, that includes a lot of the stock that people bought, and a lot of the assets that are accounted for here are part of stockholders' equity here, that are actually money that stockholders paid in order to get the very high priced shares as they used to be. Maybe even now they are, we'll see. Total liabilities sitting at $16.8 billion, and total equity sitting at $23.7 billion. So that's all fair here. And you will see that the additional paid-in capital is in the billions here from stockholders, basically. Buying shares, that's what it is. Now, the cash from operations is positive, 3.5 billion in 2018, and currently, last 12 months, 8.1 billion. So this is very healthy here. And a little bit of investing, which is nice to see the company investing in the stock market. That's something that I always like to see companies do, buying marketable securities, investing into the future. And some capital expenditures, normal stuff here. The cash from financing is interesting because, as you will see here, it's in the positive. Started going back into positive territory from debt that the company issued over here at 4.9 billion, and again 4.97 billion this time. So company seems to be issuing quite a lot of shares, quite a lot of debt, and shares actually. So the thing is, they are making some significant cash flow. So 3 billion over here, 3.1, 4.2, 4.6, and 7.1. Now they made $7.1 billion in the last 12 months, yet their market cap is sitting at $662 billion. It's almost 100 times more. But we will examine details about that on our discounted cash flow model a little bit later. So the multiples have skyrocketed here, as you can see, just because the price of the stock has been skyrocketed when you compare it to the sales, really. That's what this means, and you obviously want the lowest amount possible here to be better for you. And the Solvency tab here tells us a story of a company that has normal amounts of debt over here. I'm not too worried about that. 40%, maybe even 50% is okay in most situations. So I wouldn't be worried about that at all right now. What I do want to see, and this is what I hinted at earlier, is we want to be taking a look at the cash flow. And so this is what we're going to do. And I have created a full-blown sheet here that allows us to do projections for 10 years. So the first thing that we need to be doing is paste the amounts of free cash flow here for 5 years, 5 consecutive years, and then the outstanding shares in million over here. I'm just gonna quickly pause the video to paste that so that you don't have to wait. Okay, I just pasted everything. So this is year 1 to year 5 free cash flows so that we just got from the free cash flow statement. As you can see over here is these values. And the other thing that I added is the outstanding shares, which were 2.5 billion. And we also need those for our model. Now the next thing, we need to be accounting for a discount rate, which is about how much money we want to be making a year in terms of a percentage from our investment. I typically want to go at around 13%. You typically want, again, something that's more than 10% because you can get that from an S&P ETF, for example. And free cash flow growth to use kind of has to do with the 5-year average over here, which gets automatically calculated and it gives you a baseline. But this is the one that we are actually using. We just use this for information. And typically, I think it makes sense to go like 50% down to be a little bit more conservative. So 13% I think makes sense here. And the perpetual growth rate, which calculates the terminal value, meaning how much the company will be growing after the 30-year period, has to be conservative because we cannot have something like 5 or 6%. If we do, then this means that the company will outgrow the economy eventually, which grows at the rate of like 2 to 3%. So we can't have that. I'd like to use 1% here. And now this calculates the whole model here, applying 13% gains of free cash flow every year, and then discounts the values back to discounts values to the present. And we get the terminal value here and the total value here. It may actually be and seem a little bit weird to you that these values are actually the same here. This happens because the discount rate and the free cash flow growth are the same. Let me actually switch that a little bit so that it makes more sense and it doesn't feel like this is wrong, because it's not. So let's say that we want to be making actually no, let's say that the free cash flow grows at 12%. This is the same. This is not the same anymore. And yeah, again, this happens, and you may see that happening with a free cash flow model, because when we're projecting into the future, we give it an interest of 13%, and then we discount 13% back to the previous years. And so when we reach the current year, it's exactly the same, and this is why you were noticing the exact same present value of free cash flow on each one of the entries here. That's very, very normal. So when we do this model here, you will see that in 10 years time plus terminal value, we're getting that the price per share to pay today in order to make 13% a year annually, with a free cash flow growth of 12% and a perpetual growth of 1%, is almost $50. Yet the current stock price is $265, and this is what I was talking about earlier. It's massively overpriced for what it is. So you can use this model to play with your estimates a little bit and see, what kind of value it makes sense for you and what kind of money that you're willing to pay. But I wouldn't go more than 15% here on discount rate. That's very, very high already. And a free cash flow growth to use, with an average of 26%, you have to be like very, very optimistic to give it a 20%. And even then, look at that. It's now sitting at $68. So you can tell that based on the free cash flow the company is making, the actual current price of the stock, the market price, is very, very expensive right now. This is what it looks like. And again, it's anything probably at about $50 makes sense for Nvidia. But, more than that, we're getting to overpaid territory. All right, hope that helps you a little bit. You can find a link to the empty sheet here so that you can use it for your analysis of any stock that you want. There's a link to the description in the description box below, and yeah, it's basically a blank canvas that you can use to do your own estimates. Hope that helps you. And thank you for watching this one. If you did enjoy it, take a look at this one that I made earlier, and it's about Alibaba's estimates using the same model here. Thanks again, and I'll see you soon. Bye bye.